There is this lie that everybody tells you that you should be buying investments, you should buy stocks because they go up all the time, because it's a great investment in America, for example, here for the S&P 500. But that's a lie, because the S&P 500 goes up due to monetary debasement. The US money supply grows by 6.8% per annum. So this is the S&P 500 relative to the US money supply. If the money supply was not to go up, if our money base was completely flat, then the growth is extremely modest. The growth is only 66% over the course of 66 years. And who knows how sustainable that growth is. Valuations are currently very high, and during .com we subsequently crashed by 56%, and this year that's the .com bubble crash. I'm not saying that we're going down from here, but I just wanted to recap this very important connection. The S&P 500 is going up over time because the monetary base expands over time. Now we can refine this a bit. We're looking at US stocks and at US money supply. Let's see how well this holds for other markets, and let's see if we can potentially develop a trading strategy from that, or rather an investment strategy. This here is the European M2, EU M2, the money supply of the Eurozone, and here is the Euro Stoxx 50. So that's the stock index of Europe. Now have a look at this. This is the Euro Stoxx 50 divided by the European money supply. This chart doesn't have as much duration compared to this one here. This starts in 1959, so the S&P 500 relative to the money supply. But this chart only starts in 1987, 1 year after I was born. But still, it gives us an insight whether or not stocks might currently be comparatively expensive or cheap. The dotted lines here, by the way, that's the average ratio. Maybe that's an equilibrium price. We could definitely make that argument for the S&P 500 relative to the money supply. Sometimes we're extremely cheap relative to the equilibrium, sometimes we are expensive. This is just the average. So maybe this works for Europe as well. Maybe European stocks are currently cheap. Why don't we make a more direct comparison? So again, US M2 relative to Europe M2. Then we're getting this chart. Now it becomes interesting. We've got a growth rate of the European monetary base relative to the US monetary base, and then we've got a phase of a relative decline where Europe expanded its base slower than America. Now, what impact does this have on relative stock market performance? That's what we see over here. This is the Euro Stoxx relative to the S&P 500. We can see that during a phase where the European money supply expanded quicker than the US money supply, stock market performance was relatively even. Once Europe expanded its monetary base slower than the US, the stock market in Europe did much worse, an underperformance of 70%. So it seems like the US has a structural advantage over Europe. Europe can only keep up with its stock market performance when they are printing money quicker. Once they don't print money as quick, or once they even get more restrictive on monetary debasement, the stock market collapses. Over the very long term, Europe has a harder time. Those two data points are also quite comparable. And of course, the European stock market did much worse than the US stock market in aggregate. But now Europe seems to start to expand its base a bit quicker again. And so the relative performances in the stock market aren't that different anymore. Now this is the entire European Union relative to the US. Let's take the gem of Europe. Let's take Germany. It's the leading economy in the US. Here we do see that German stock prices did outperform the US stock prices during times of expansion. But of course, there was also the underperformance. Now there's a little hint here. Germany's stock market actually did not do much better than Europe as a whole. The reason why here the German DAX relative to the S&P 500 outperformed was not because German investors made more money. It was because the German stock market is a performance index. And the S&P 500 is a price index. So in here, we have a positive drift for German stocks of roughly 2% per annum, right? The dividends that get paid every single year. So this is actually overstating how well Germany does relative to the US. In the end, it seems to all flow to the US. The US market is outperforming everything long term. So we've got the US money supply, we've got the European money supply. Let's see how well this effect works with another example. Let's have a look at the Japanese money supply. Here is the Nikkei 225 relative to the Japanese money supply. Here's that average ratio, so we're very close to the potential equilibrium. This chart is very long in duration though. It starts in 1960. And Japan did have a quite good run up until the beginning of the 1990s. So let's see what happened with the Japanese monetary base relative to the US monetary base. Here is the chart. Japan expanded its monetary base very, very quickly up until 1990. That's when the US started printing money faster than Japan. Now, this is not just random central bank printing, because a good chunk of the monetary base gets expanded by people just taking loans. If you create a business, if you buy a house and you go to the bank and you apply for a mortgage, then due to fractional reserve banking, new money is created and that expands the money supply. So a growing economy is reflected in a growing monetary base, at least partially as well. Now have a look at the Nikkei 225 relative to the S&P 500. When Japan didn't expand its monetary base anymore as quickly as it used to, the Japanese stock market relative to the US stock market collapsed by 93%. And why do I find this analysis so interesting? I find it interesting because the trends in the relative monetary base are somewhat consistent. They are much less volatile than stock prices. With stock prices, we don't really know what's doing better and where's the trend headed. But with those comparisons in the monetary base, we do see relatively constant trends. And we also see how Japan continues to underperform with its monetary base expansion compared to the US. So based on this chart, I don't think that Japanese stocks will outperform US stocks in the next 10 or 20 years. At least if this continues to go down, which is probably quite likely. Again, those are very long-term trends. Interestingly enough, Europe is a bit more erratic in its monetary policy relative to the US. When Europe is okay to print more money, they can temporarily keep up with the US. When they don't print more money, they're having a hard time. And currently, they are printing slightly more money. But again, we do know the long-term trend is very much pro-US. And so I do think there is a good chance that stock market performance and global power in general will continue to concentrate in America. People will continue to buy US stocks. People will continue to buy into the global tech monopolies, and that's going to drive economies around the globe. If you found this interesting, feel free to give it a like. Feel free to also subscribe. I publish this regularly on this channel. If you want to know how I manage my money, what kind of investments I do and how I trade, feel free to also check out the premium membership. Link to premium is down below in the comments and here on the screen. Thanks for watching and see you next time. Bye bye.